Ladies and gentlemen, queens, kings, captains, and yesterday, as I found out, parents, fathers, grandfathers of this credit sharing information industry. Good morning. I'd like, with your permission, to first also start with recognizing the children and grandchildren of the CIS industry, and that's the Fintech companies and the startups that are getting into this space of digital lending, who, compared to my presentation last year, when I was presenting from the context of banking, there wasn't much of them. And today, I look around, I see Tala, I see Branch, I see myself also in the fintech industry. I think I'd like to recognize and commend the CIS team for allowing the children and grandchildren to join this conference for a collaborated discussion. I'll start with some context, what my presentation is about. I'm glad that it's only 10 minutes. I was wondering what I would do with 30 minutes, because all I did was put lovely pictures. So I'm going to be going through the presentation pretty quickly. I'll start with the introduction of Oprah. I look around the room, I see people who would have owned the first generation phone, the Nokia, the Siemens, the Ericssons. And I think we all may recognize Oprah, but I'd like to introduce a bit about Oprah and what Oprah is. I'll get on to talking about two main general areas, and that is the state of financial technology today, as we see it, and what is happening to financial technology, or fintech, as it's been coined. It's been about 20 years since. It's evolving into something more interesting called TechFin. So I want to discuss a bit about those two perspectives. And then I want to talk about something I refer to the post-mobile money era. Very prevalent in Kenya. And what is the effect of the post-mobile money era? It's been 12 years since mobile money first started. We've seen a lot of business models come out. We've seen a lot of things happen, especially for the context of CIS, digital lending. And what does that look like and what is our impact? And then finally, I do have assertions I want to refer back to in the context of those two big areas of discussion. Before I begin, I want to refer to the opening remarks that were made yesterday by the governor, Dr. Njoroge, by Jared, and by Mr. Ingera. Very briefly, the things that stood out for me. Mr. Ingera referred to 1,700 digital lenders in Kenya. It's a pretty big number. But today, in conferring with Safaricom, and most of these digital lenders do use mobile money for distributing their services. They recognize about 17 digital lenders. That is still quite a fair few lenders, given that in the last 3 to 4 years, we only had up to 4, and then we have now 17. So that's quite a number. Mr. Habil Olaka also did recognize that digital lending is also being done not just by non-bank, non-financial institutions. It's also being done by telecommunication companies. So Obam does need to be here, even as an engineer. And I'll talk a bit about why telecommunications is a big part of digital lending. He did also recognize that telecommunication companies, even banks themselves, are offering digital lending, as well as non-bank and non-financial institutions. Finally, to Dr. Njoroge's comments and in his guidance in opening this conference, he did challenge us. He did challenge us about being snobs, if you remember the reference to V.S. Naipul, in being different about how we view, and unique about how we deliver our services. And that was a fantastic challenge from the governor. He did ask us to recognize three things when we think about digital lending: data, speed, algorithm, and scores. I think these are very critical areas around delivery of digital lending. And then he did refer to about 4 CBK pillars. And the reason why I go through this, because I want us to pick a few points given that guidance from the governor. First and foremost is customer centricity. I think this came out very strongly, which is what CBK is very passionate about. Accuracy and real-time data is very important. Risk-based credit pricing, or modeling for that matter, how we make decisions, to be able to determine that the customer qualifies for a loan, transparency, and ethics. I think those were the guiding principles in context of this conference. I know I stand here, last year I spoke as a banker, this year I don't speak as a banker anymore, but I think it's a good thing that both parties are now in one room and having a conversation about this fast-growing area. I'll go to a bit of introduction of Oprah. For those who don't have Oprah, show of hands who hasn't heard of Oprah. Just quick show of hands. Quick show of hands. Never heard of Oprah. Okay. Just as well there we go. Right, the slides may not be clear, but Oprah, as you see the logo, O there. Oprah is about just almost 20 years old. It's a software development company that has been known to introduce the internet to Africans for just about 17 years. When you think about the first mobile phone that could be able to connect to the internet, it was able to connect to the internet using the Opera mini browser. So Oprah was involved with introducing the internet and has been doing so for the last 17 years to many Kenyans through contracts with the manufacturers, so that when the devices end up in Africa, they actually have an Opera mini browser. And the reason why it's called mini is because it's light and it compresses data, and it allows the customer to conveniently, without too much processing capacity from the mobile phone, access the internet. And over the years, Oprah has grown. Oprah today has about 100 million Africans accessing the internet every month. I'll share with you some data around how the distribution across Africa. Of course, mostly the Opera mini browser, given the state of the devices that we have, but we see customers growing with smartphones over the years, and we're seeing the numbers in Opera, the standard browser, being used in Africa. You could compare Opera browser with Chrome, iOS, Safari, Internet Explorer, but Opera has been specifically known for the mobile device. And in Africa, more so Opera Mini, which was what was introducing Africans to the internet, and affordably. So we have a proprietary technology where you're able to compress data and move on. Let me just move on. So we, later on, earlier this year, decided, over and above introducing the internet, let's organize what people are viewing on the internet, launched Opera News as a standalone app, and we also have that product. This year, we have introduced two products, specifically within the financial services space. I think Opera decided to focus on, over and above just introducing the internet or organizing the internet for customers, can we deliver more for consumers, going into content and financial services? And this year we launched OPay and OCash, OPay for payments and OCash for lending. But as you can see from that slide, 60% of users in Kenya alone use Opera mini browsers to access the internet. Across Africa, you can see we have 27 million in Nigeria, 10 million about in Kenya, and South Africa we have about 10 million. Totality across Africa, we have about 100 million, but those are the key markets. This is an important slide. I don't know if you can see it, but I draw you to the bottom line there where it says smartphone and feature phone. We started with introducing the internet through feature phone. That has significantly changed. You can see now over 50% across the key markets, Nigeria, Ghana, Kenya, and South Africa, are able to access or are using Opera specifically on smartphones and not feature phones anymore, which is a good story because customers are getting, these devices are getting smarter and customers are able to access increased capacity in terms of mobile phones and what they can then do with mobile phones. So I want to quickly jump in, since I have 2 minutes, into fintech in the context of where we are, the state we are today. But I want to compare it and give it a different perspective, which is the new and incoming or really growing perspective, which is called TechFin. When you think about banking, when you think about how do we make services affordable, accessible, faster and easier, that's what banks started from, and it's developed at the beginning as channels. And even as far as now, banks launching their fintech companies, like Equity, as you would know, with FinServ. And the premise of fintech was really to just make things, can we grow customers more? Can we make cost of service cheaper? Can we allow revenues to grow? And really just optimize the business model. And that's what fintech refers to. In this day and age, in the platform age, where you have your Googles, your Amazons, your Oprahs, your Alibabas, your WeChats or Tencents. These are global platforms that have been able to build very strong digital infrastructure and are able to attract millions and millions of customers. When these people decide to get into the financial services space with such strong capability, that is what we're referring to as TechFin, because they rebuild the entire process altogether. And that's what I really like to comment about that. Jack Ma coined it best. Jack Ma is the founder of Alibaba and Alipay, just over 1 billion users in China, who have quite significant processing capabilities. He says, fintech takes the original financial system and improves its technology. TechFin rebuilds it from the bottom all the way up. To just draw some comparisons and understanding, so there is the state of financial technology today, and we can see that people are trying to be more efficient, trying to offer services further down, faster, easier to customers. But there is the perspective of TechFins, where you have large platform providers who are offering financial services in a completely first principle model. Mobile money, if you think about it, is a TechFin model. Online payments, social payments, things like being able to lend or lend between one person and the other, which is P2P lending, those are significantly TechFin models. When you think about crypto today, as Opera, you have 100 million users. How do you allow 100 million users in 52 countries, 52 different regulations, 52 different currencies, be able to send money to each other as simply as how they tapped on Opera Mini and browsed? So that's the thinking really about TechFins and what is informing the transformation of fintech today as we see it. If you look, this is a slide that just compares, as of last year, August 2017, the largest digital lenders in Kenya alone. You can see it really started with banks. Banks are the ones who actually started digital lending, believe it or not. And it was really as a fintech model to try and figure out how do we offer loans faster, easier, cheaper? How do we grow customers? And through partnerships with the telcos, we're able to very quickly leapfrog and start digital lending. However, we then have now the new entrants, such as ourselves, who get into now a very different thinking about how you offer lending. Having come from one of those banks that launched the fintech model of digital lending, the KPI then was really, let's acquire customers, let's make it easier, or let's make it very cheap to deliver a loan. But when you think about from a TechFin perspective, which are the laggards or the last two, it's not really about the customer base. It's really about how do you be efficient with data. And that's what I want to pose, what is happening in the evolution of fintech and into TechFin. Today, as Opera, we have a product for micro-lending called Okash, which is predominantly a TechFin model, because when we thought about what more value can we offer customers, we thought about not just giving them a loan. We thought about what are the key risks with giving people a loan. Do you know the person who you've just registered? Are they who they say they are? Are you able to efficiently collect the money back? Because the whole point isn't about at the end of the month or at the end of the year looking at an NPL, but how robust and efficient are you in being able to determine the intent of the customer and the capability of the customer to repay you, and be able to simply get the money paid back. To put it to context and why it's a TechFin model is because one of the first things we built was not an app. It was not a partnership contract with the telco. One of the first things we built was a framework for how we will manage data. And we used a data framework called Hadoop. I don't know sorry if I sound a bit technical, but it's basically a structural framework of how you will process large amounts of data and how you will continue to compute large amounts of data. Because what is important is not where you get the data, but what you do with the data to inform your business model and your decision. And that is what we're doing with data today as we onboard customers. Because we want to be able to build intelligence and learning as we get on. When you look at platforms like the digital lenders, the banks who started before, the Mshwaris, KCB, and Pesas, they have 7 to 5 years experience of collecting data from customers. But I can guarantee you, not enough value is being pulled out from that 7 years worth of data. It's enough to be able to be predictive about whether or not a customer will be able to pay you. So when I speak about data, I know it's a sensitive topic, and I wanted to challenge Mr. Obama. In as much as we protect the customer and we want to protect the customer, if that customer is not able to monetize or commercialize that data, it's of completely no use. It's unfortunate that the guard didn't give you a limit for a loan, given all that data you wrote down. Or at least, what value are you getting from all that information you gave out? You should demand for some value. And we should educate customers that this is your data. There's a lot of information sitting here, and they should be able to ask, for this information, what am I getting? Yeah? Because the social network platforms, your Facebooks, Instagram, they take data and they use that data and sell it. But there's no value to you. The only value is the fear of missing out, or the fear of not being part of a community. But when it comes to financial technology, there needs to be real value going to the consumer. So there's a lot of data. So there's 3 largely sets of data that we offer customers. There's the data that the customer willingly gives us. There's the data that the customer we get from these devices. And there's the data that we get from third-party sources. And really, it's for the consumer to be able to balance the 3. I didn't want to put too much case studies, data and references to case studies. I just want to put 3 pictures up there. Today, we have a fintech called Wonga. I think it's in South Africa. I think it's founded in Britain. It was going to be valued for about $1 billion this year if it listed in the New York Stock Exchange. Predominantly payday loans, or similar to the model that we're launching, that is being realized today for microlending. 2 more minutes. And Wonga today, because of not being customer-centric, is at the verge of collapse. Actually, I questioned earlier this week, it's a fintech that's going to receivership, to be quite honest, similar to a bank, because they have to give the business to somebody who can guide them out of the problem they're in, because they were hit by regulatory caps, and because of the regulatory caps, customers were eligible to make claims that they were not treated properly. And today, an almost $1 billion company is going down. A fintech. Payday loans, we all know them. It's been quite a crisis in the US market and continues to evolve and grow. But I think there's a lot of lessons in such models that we can learn as Africa on how then do we offer credit? How then do we offer access to financial services? One of the fantastic models, I say one of the best innovations in banking after the ATM, in my perspective, is the credit card. The credit card attempted to do one fantastic thing. A lady who sells vegetables borrows in the morning and repays in the evening. Does that woman require a term in the loan contract? Absolutely not. I don't believe so. I think she should be allowed to repay and be priced at whenever she can repay. So throw the term out. If she pays in the next 1 hour, in the next 2 hours, allow her to pay for having repaid that fast. But I think going back to the credit card model, it's one of the fantastic, things that we've seen in the banking industry in developed markets. But now, given that the distribution of payments, or the distribution of money, isn't as prevalent in Africa, we see, or I see, that mobile money can evolve into a convergence of credit and payment. Now, it's not something I'm innovating here. It's something that's actually being done today. And I want to quickly fast forward to it as I get into the post-mobile money era, because this is something I'm also very passionate about, we're very passionate about, and it's something that is going to help us understand how do we then deal with this environment where money distribution is at its best. Kenya today enjoys mobile money or a payment platform with up to 80% adoption. It's unheard of. Even in China, you have two big players who've not reached barely 45%. But we enjoy significant penetration of mobile money, and we have figured out money distribution. And it's because of that we have now these models coming up. Lending, betting, all these models are popping up because we figured out money distribution. When we come back to the post-mobile money era, I want to talk about one product that I was fortunate to be involved with last year, and I expect is currently being tested, and I expect it to be launched this year. So as we're thinking about how do we regulate digital lending, how do we bring digital lending together, mobile money era is evolving into the model of credit and payment. Today we all know of Okoa Jahazi, we're able to borrow money for purposes of accessing airtime. But today, as I'm aware, and it's not a secret anymore, there's a product being tested to allow M-Pesa to act as a credit card, so to go into credit. So this is more of a TechFin play on how banks have delivered credit cards, because mobile money has been very convenient, but for purposes of making a payment, it hasn't been as much. So today, M-Pesa is about 22 million. This is at last year. So this year it's about 22 million monthly active users. Every month, 7 million of those users have their transactions fail because of insufficient funds. 7 million, which is about 43 billion shillings. 43 billion shillings worth of insufficient funds. So today, if that credit was offered, that would easily convert to a tier 1 bank in 6 months, for those who are bankers here. 43 billion shillings to be able to avail and access, and it's not because the customer does not have funds. I'm sure we've all tried, and for the Kenyans in this room, you've tried to do a transaction and it came back insufficient funds. It's not because you don't have the money, it's that you had to go back, go get the money, and then come pay. 90% of those transactions get fulfilled within the first 15 minutes. But the convenience of credit and payment is what we're now evolving to, and the digital infrastructure that a technology company has built has been able to do this in 6 months. Before, when I was in banking, we would attempt this and it would have taken us 2 years. So this is the perspective between Fintech and TechFin and what we see. But basically, credit, I believe, even for digital lenders in this room, is going to evolve, not just as a cash loan, but more into what we believe in at Oprah and at Okash, into purpose lending. As opposed to giving you money simply to be able to access it, can I give you money to be able to fulfill your life? Whether it be it for school fees, whether it be it for healthcare or for cover, it's the convenience of credit that we want to offer. So my final assertions, in the perspective of where Fintech is today, in the perspective of what it's evolving to into TechFin, and in the perspective of our conversation in this room about digital lending in the context of credit information sharing, as we were challenged by Dr. Njoroge, I have 3 assertions. I think we have to evolve from access to quality. That's what is going to happen with digital lending. As more and more banks and non-financial institutions get into this space. I think it's important to start thinking about first principles. First principles is when you start thinking from afresh. You don't assume that this is what you used to do. I remember in the beginning of my career, we tried to digitize loan top-up. I don't know if you all know what loan top-up is. But basically on USSD, you ask for a loan top-up. Very clunky service. Just because you have the product, you just iterate and build on it. But really, can you start thinking about it afresh and start offering convenience to the customer? My third and last one is from scarcity to abundance. Similar to Dr. Njoroge, I do not believe in the word disrupt, although I do believe in the word exponential. Exponential. So I believe that we can, if we focus on those first two principles or sessions, move from scarcity to abundance. I'll pause there, and thank you very much.